This is the first class in a series of classes that we're doing. Right now we have 4 classes scheduled, and I've been watching if some of you have signed up online. I've watched a few of you have signed up for multiple classes. That's really awesome, because like the mayor said, this is a free service that we do. Credit Union West has been teaching classes in the city of Surprise. We teach in the city of Peoria, Avondale. We do this on a normal basis because we do feel that it is important information for everybody to know. So as we go through, in your packet, you'll see a little folder like this, or a little packet like this. We'll go through, you can follow along, take notes. If you can, maybe hold the majority of your questions till the end, because we may answer them as we go through. And if you don't want to hold your question, that's fine too. We've got a small group, so it should move along pretty good. What we're basically going to learn tonight, we're going to talk about mainly credit reports and credit score. So when you leave here tonight, we're going to talk about who needs to build good credit and why, the significance of your credit report and your credit score. We're also going to talk about steps that will hurt your score and steps that you can take to help your score, and also your rights and responsibilities. You know, everybody knows they can get their credit report one time free a year, and there are other times that you can get your credit report free, and we'll kind of cover some of that. So I'll start out. I am going to make this a little bit interactive, so hopefully you guys will talk back to me. Who needs to build good credit? Anybody? Everyone. I know. They're like, wait, that's too simple. That's an easy question, right? Everyone, obviously. When when you're just starting out, you graduate from high school and you go off to college, one of the first things that our kids are getting bombarded with is, credit card applications. I know my daughter brought a couple home going, look what they want to charge me for interest. So, they're getting hit very early on, and for young people, it's great if they're equipped with the knowledge to make good decisions. For those of us who are a little bit older, we may have had a few hiccups along the way, and that's okay. The good news is there are things that you can do to get yourself back on track. So as we go through, the first thing that we're going to talk about, we know who needs to build good credit. Why is it important to build good credit? Anybody? Why do we care what our credit score is? Why do we want to build good credit?
It doesn't depend on your interest rate.
It can make
you whether you're a high interest rate or you have a low interest rate, or whether you can get a loan or not get a loan.
Yep, you can save money on loans. Any other reason? How about employment? Did you know that employers will oftentimes pull your credit? Think about me at Credit Union West. They're not going to put somebody in charge of your money if I can't manage my own. We do a lot of classes with Luke Air Force Base. We started out as Luke Federal Credit Union. There are military members who are losing security clearances if they don't manage their money well. So employers, that's another good reason to be mindful of your credit report and your credit score. Here's another one. We'll see if anybody knew this. Insurance. Car insurance, homeowners insurance, they can factor in your credit score as part of your insurance premium. And people say, well, how is that? I mean, if I have a bad credit score, it doesn't mean that I'm a bad driver. But the insurance industry loves statistical analysis. They can show a direct correlation between those with lower credit scores have a tendency to file more claims. It's not that anybody's a better driver. It's just a level of risk that they're able to assume. Okay, how about rental or utility deposits? I know when we first moved out here, I called ahead to the utility companies to get everything set up, and almost all of them checked my credit to determine how much or if I was going to have to pay a deposit to get my utilities hooked up. So that's another area. Okay. Probably the biggest area that everybody thinks of is saving money on interest rates. So we did put an example in here on a vehicle loan, and I'm going to pick on Chris a little bit. I was really good, managed my money really well, so I had a 702 credit score. Chris, he had a couple hiccups along the way. His credit score was 624. Didn't know I was going to pick on you, did you? We both apply for a loan for $25,000 for a vehicle. And because I had the higher credit score, I was able to qualify for a loan at 7.75%. His was 10.75%. 60 months, same vehicle. How much more did he pay for his vehicle? Not only did he pay $36 more a month, but over the life of that loan, he spent $2,100 more than I did. Now, would anybody like to have a couple $1,000s? Yeah, probably. You'd like to save some, right? Look at the example for the home loan. Same thing, one has the higher credit score, but over the life of a 30-year loan, that person with the higher credit score was able to save $142,000. Especially on a major purchase. This is why it's so critical. If you know you're going to be buying a home or some major purchase, maybe even put off making that purchase until you take the steps to get your credit score where you want it to be, because it can save you a lot of money over the long term. I'm sure there's somebody here who would like to save $142,000, right? Silly question. And before we kind of get into the credit score, I like to touch on, because I've had people in some classes say, well, credit cards are evil. I don't even want to deal with credit. I'm just better off paying cash for everything. So I like to touch a little bit on some of the advantages and some of the disadvantages of having credit at all. What would you think an advantage of having credit would be? An emergency. We do recommend emergency savings for that, but in an emergency, if you don't have the emergency savings, it can cover you for a little bit. What about that home purchase? Does anybody have $170,000 to just pay cash for a home? Okay, so it lets you make big purchases, but pay for them over time. And I know you guys can identify with this. Have you ever walked into a store, you're making a purchase, and they say, today you can save 10% if you sign up for our store credit card, right? Well, if it's a major purchase, it might be worth that 10% to apply for that card. That's an individual decision, but you can qualify for additional discounts. That would be another advantage. What would be a disadvantage of credit? Anybody have a disadvantage? Do you think it can provide a false sense of security? I love when we do classes with young children. We did a whole series of classes with different Girl Scout troops, and I would say, okay, you're out at the store with your mom and dad, and your mom says, sorry, we can't buy that because I don't have money. And I just kind of pause, and 9 times out of 10, there's one kid in the class that goes, just pull out the credit card. So it can kind of promote that temptation to overspend. And they're learning it at a very young age. Another disadvantage would be obviously additional fees. If you are getting overextended, or if you're putting things on credit cards and taking a few months or years or whatever to pay it off, there's going to be interest charges. There may be late fees. It just depends on what your situation is. But you're going to pay extra for having that credit. Okay, so now we're going to get into credit report. Just kind of curious, how many of you have checked your credit report, say, in the last year? No? Okay. Very good. What is your credit report? What does it tell you about your situation? You guys are way too quiet. See, I could pick on you because you said you checked your credit report. What kind of information was on your credit report? Obviously not specifics, just general information.
Yeah, it shows the different accounts that you have open. It shows your payment history over time, whether you were late or not. It gives you, like, it shows inquiries, like when companies want to extend you credit, I don't know why they do that.
Yeah.
But it goes on there. It shows any kind of public judgments, I think.
Mm-hmm. Judgments or collections, yep.
Bankruptcies, anything like that.
You get an A.
And your credit score.
You get an A. Now your credit report, and we'll get into this a little bit later, but your credit report itself will not show your score. You can get your score. There are ways to get your score. But your credit report, I like to call it your financial report card, because it has everything that he just said, all the accounts that you have, how well you've paid, if you've paid on time, how many times you've been late. It'll show what your credit limit is, and it will show how much of that credit limit you've used up. Okay? Bankruptcy collection items, credit inquiries, which we're going to get into a little bit more when we get into the formula for the score, because that's one area where a lot of people aren't really sure, how that affects their score. But some basic stuff. There are 3 credit bureaus: Experian, TransUnion, and Equifax. And I will tell you, if you've looked at your credit reports, they will vary from company to company. And the reason that is because every financial institution doesn't report to all 3 bureaus. For example, my daughter, she actually used to work for the credit union, but when we pulled her credit report, there was a credit card and a car loan that doesn't even show up. When we pull your credit report at Credit Union West, we use Experian. The company that she had the credit card through and the car loan through, they reported that to TransUnion. So I'm only telling you that really so you know when you look at the different credit reports, you go, well, wait a minute, this account's over here, but it's not over here, something must be wrong. That's not uncommon to find that, okay? So just so you know what you're looking at. Obviously, since everything doesn't show up on every credit report, your credit score is going to vary too from company to company. I know when we refinanced our house, we got a sheet that actually showed what our credit score was with each of the bureaus. So that was I thought that was kind of interesting, and showed the different ranges for each of the bureaus. So I just throw that out so you know when you're looking at them, don't be surprised. They will vary. Okay, so we know what your credit report is. It's your financial report card. What is your credit score? It's that mystery number, right? Nobody knows what makes up that number. You're going to know before you leave tonight. Your credit score is a snapshot in time. And the reason that I bring that up is if I checked my credit score today, it's not going to be the same 6 months, a year from now. It is what it is at that particular time that you pull your credit score, okay? Where your credit report has all of your history, the score is just a snapshot, okay? Scores measure, it's basically a way to measure your credit risk. What is the likelihood that this person is going to, pay back on time, all that kind of stuff. That's what they use that score for. And when we talk about credit score here and the formula, we are talking about FICO score. You've heard FICO, right? Everybody heard that term? It's just a formula that was created by the Fair Isaac Corporation, so that's why they call it FICO score, just abbreviated. The higher the score, the better. And scores will range anywhere from 300 to 900. We kind of break down the range of scores there. And you can see about 60% of the general population has above a 700, but actually the average score by the Experian model is about 673. And some people say, okay, well, what really is a good score? What does that really mean, that 3-digit number? So we put on this worksheet how we look at credit score and how we kind of grade out where you would fall. You know, you talked about qualifying for better interest rates and stuff. So we kind of use that little scoring, that grading system down at the bottom to determine where you're going to fall as far as, you know, interest rate and all that kind of stuff. So I had a young lieutenant out at the base one time who came up and he goes, you know, I've got a 750 credit score, but I really want it to be an 800, which is, you know, great goal. But you can see by our tier system, if you're 720 and above, you're A+ credit. You're you know, going to qualify. Obviously, there are other things that go into qualifying, but you're going to be A+ credit with us. So typically, you would qualify for the best rates. Okay. Any questions so far? I know I told you to hold them to the end, didn't I? Oh, because this is the section that's really going to bring up the questions. Okay. So the next thing that I want to get into is just giving you some definitions for some terms that we're going to use, and then we'll get into that magic mystical formula. And the reason why I say it's mystical is I used to be a financial advisor, and up until probably about 4 or 5, maybe 5 years ago, people really didn't know what that formula was made up of that went into your credit score. And the Federal Trade Commission said, wait a minute, in order to give people an opportunity to improve their credit score, you gotta tell them what goes into the formula. So there were a lot of things that that the financial industry might have been telling people, you know, if you have an old account, close it, whatever, that we thought was good recommendations. And when the formula was put out there, we went, oh, wait a minute. So I'm sure there's going to be some things that I'm going to cover that you're going to go, oh, but I heard. I'm telling you, this is the formula. So we'll get into that. Secured and unsecured. This is going to be different types of loans or lines of credit. If you have a secured loan or secured line of credit, it means you have secured that with some type of collateral, whether it's a CD, a mutual fund, a home, a car. That would be a secured loan. So if you don't pay that debt back, that financial institution can take that property, whatever you use to secure that loan. Okay, everybody pretty clear on that? Unsecured is just your signature, you saying, yes, I'm going to pay this back. Which do you think is looked at more favorably? Secured, because it's less risk for the lender if there is some sort of property tied to that. Installment and revolving. Installment loans are basically going to be anything with a fixed term. That would be like a car loan. If you borrow $25,000, you pay it off in 60 months. This is what your rate is. This is what your payment is. At the end of 60 months, you don't owe anything. The account is essentially closed. You can't run out and, you know, charge back up on that account, right? It's a closed-ended loan. Revolving is just like it sounds. That would be like a credit card or a line of credit where you maybe have a $5,000 limit. You can run out and charge up $5,000. You pay it off. Tomorrow you can charge it right back up to $5,000. So it is constantly revolving. Seems pretty simple, right? Everybody's like, okay, very good. Now, here's the part you're really wanting to know about. What goes into making up your credit score? 35% is based on payment history. Do you think it's important to pay your bills on time? If you are late on one payment, regardless of dollar amount, it can affect your score up to 100 points. Obviously, that depends on how late you are and all that. But, wow, 100 points. I like to say, do you think it's important to pay on time? That's 35% of your score. That's a big chunk. So that would be one area that I would certainly focus on. The good news is, you know, I like to say as we go through all of this, I like to say life happens along the way. There are times when, you know, something happens, oops, I was late. The important thing to remember is if you run into that situation, be very diligent from that point on to make your payments on time. Because the good news is the longer away you are from that late payment, the less weight that it carries on your score as well. Okay? 30% of your score is based on capacity. And this is one of those areas where I say we thought we used to know, but here is what capacity is. Let's say I have a credit card, and I like to use nice round numbers because, you know, doing math in public sometimes can be fun. Let's say I have a credit card that has a $5,000 limit. I have charged up $1,000 on that credit card. I've used up 20% of my available capacity. Okay? That means I have 80% left. The higher available capacity you have, the better. So when we go back to that, you know, the old recommendation was, you know, let's say I have two credit cards and they both have $5,000 limits, but I'm only using one, and I go, you know, I'm really not using that other credit card, I should just close it. Well, by closing it, I've now taken away $5,000 of capacity. And that was kind of the recommendation that people were giving before was, man, if you have accounts you're not using, just close them. They're not doing you any good. But having that available capacity, the way that it's looked at really as far as for your score is you have shown discipline because you're not maxing out all of your capacity, you're only using a small portion of it. So you must be budgeting right, you're living within your means, you're not getting overextended on credit. Okay, so the larger the capacity, the better. And here is one very strong reason why you'll want to look at your credit report. When you look at your credit report, they'll report, I said, you know, here's what your limit is and here's how much you have charged up on it. Some companies do not report your limit to the credit bureau. You might know, okay, I have this credit card, it has a $5,000 limit. If it does not show up as a $5,000 limit on your credit report, you could have $5 charged on that, and the credit bureau doesn't know what your credit limit is. So they look at that as you're over your capacity. It could be having a negative impact on your score. That seems wrong, doesn't it? Yeah. So that's just something that you want to look at. That is one, if you have a card for somebody that's not reporting the limit, that would be one card that I would maybe look at and say, okay, does it make sense to have this? There, you know, there might be another reason why you have that particular card. But again, if you are using that card, depending on when your credit score is pulled, if there's a balance on it, it could actually have a negative impact on your credit score. So, okay. So those are between those two, that's over half of your score right there. So if you're going to focus on any areas, those would be the two main ones that I would look at. Paying on time and what kind of capacity do you have. The next piece that goes into making up your credit score, 15% is based on length of credit. I used to say, anybody have the first credit card that they ever opened, still open? All right. That's good. See, so you probably have some, lengthy credit history there. That's good. Again, it's so funny because we've done so many of these classes, and it's always interesting when you hear different stories and somebody will go, oh my gosh, I just closed the very first credit card that I ever had. I've just closed out all that history. That would be one reason that, again, maybe you don't want to rush out to close that account. It may not be one that you're using on a regular basis now, but it's not hurting you to have it on there. 10% is accumulation of debt in the last 12 to 18 months. There are going to be all kinds of red flags that go up if I go out and I buy a house today, and 2 months from now I buy a new car, and then I go and open, department store card maybe at the room store to buy furniture, or I start opening a lot of accounts in a short amount of time. That's going to send red flags to the credit bureaus, basically saying, okay, what's going on? Why all of a sudden is this person opening a lot of accounts or trying to open a lot of accounts? Because he had mentioned about inquiries on your credit report. Every time you go to apply for a loan, some sort of credit, it's going to show up as an inquiry on your credit report. And there's two types of inquiries. A hard inquiry, which will affect your credit score. And that's where, again, you're applying for a loan, you're asking for credit. That would be considered a hard inquiry. A soft inquiry is when you get those pre-approved credit card offers, or any kind of pre-approved offer. If an employer is looking at it, it might show up as a soft inquiry. Those, although they show up on your credit report, do not in any way affect your credit score. That's the good news. But just in case you guys want to get out of getting the pre-approved offers and kind of want to minimize the mail, we do have that information in here, how to opt out of those. So, and we'll kind of talk about why that's a good idea. Okay, so let's say that you are in the market to buy a car. And, again, we've all heard you should shop around for, the best rates, shop around for all of, your financial products. You can do that. Again, the Federal Trade Commission kind of came in and said, wait a minute, in order to give people the ability to do that, we need to give them kind of a time frame to do that. So let's say that I walk onto a car lot one day and I say, gosh, I'd really like to buy this car, and they say, okay, give us your driver's license, sign here, they're going to pull your credit. And you visit 4 other car dealers over the next week, and they all want to pull your credit. Number one, you don't have to let them. I would recommend get pre-approved, put some power in your hand, then before you go out there. But let's say that you let all 5 car dealers pull your credit, and you've done that within a week time frame. That's not a bad thing, because as long as it's done within a 14-day time window, it only counts as one hard inquiry on your credit report. That's good news. I know. Yeah, see? You've learned something new, haven't you? Good. Again, and that's like inquiries. It's not, if you try to apply for a home loan and then a car loan, and then the credit bureaus know there's a code that's put in that tells them what type of loan you're applying for, so they'll be able to see that. So like inquiries, as long as they're done within a 14-day time window, will only count as one hard inquiry. Okay? And the last piece that makes up your credit score is 10%, and that is your mix of credit. And this is where we say you should have some installment loans and some revolving. If all you have is credit card debt and you don't have any installment loans at all, that can be looked at as, oh my goodness, okay, here's only revolving, only unsecured. That could have a negative impact on the score. So you want a healthy mix. It's good to have not necessarily all at one time, but if you've had a car loan, you paid that off, you've got a credit card, that's a mix of credit. So that's a good thing. And I love on here, we like to call the, because this is financial fitness, we love to call the installment is the good cholesterol, revolving is the bad cholesterol. Okay. And again, their secured loans are looked at a little bit more favorably than unsecured, and usually carries a lower rate, again, because there's not as much risk for the lender. I really do like the credit score, because this is the big equalizer, the good news of what is not in your credit score. Everybody know who Steve Nash is? Phoenix Suns basketball player, makes a lot more money than I do, but I could actually have a better credit score than him, because it's not how much you make. Income is not factored into your score at all. It is how well you manage what you have. Now, I do like to point out, yes, income is used in a lender's decision whether they're going to extend you a loan. They do look at debt to income ratio, length of employment, all that kind of stuff. But if you're thinking, okay, my credit score is a 650 because I don't make very much and it will never be any higher, that's not true. Okay? So to me, again, that's the equalizer. I just like to walk around and think I could have a better credit score than some of these professional athletes or whoever. So that just makes me feel good. Okay. So any questions about what makes up the credit score? Anybody learn anything new in just that little piece? That's usually the piece everybody goes, oh, wait a minute, that's a little bit different than what I thought. Okay, so we will go kind of quickly through some of the steps that hurt your score and help your score, because we kind of covered them when we went through the percentages. Actions that will hurt your score, obviously missing payments. We already saw what kind of impact that had. Credit cards at capacity, and I don't know, Chris, you could probably either agree or disagree with me on this. Generally, you want to be below 30% of your capacity. So again, if you have a $1,000 credit limit, then you wouldn't want to have more than $300. That's just a guideline. Again, there are other things that are factored in, but generally below 30% of your capacity is what you want to stay under. Closing credit cards, shopping excessively, having more revolving loans in relation to installment loans. But we're going to be positive, and the steps we can take to help our score: pay down the credit cards. Just to give you an example, if you had $2,000 charged on a credit card at 18%, and you were only making minimum payments and didn't add any new charges to that, any guesses to how long it would take you to pay off that credit card? Come on, guesses. How long? $2,000. You're only making minimum payments.
5 years.
5 years?
7 years.
7? Do I hear higher?
Maybe you never pay it off.
30 years. Think about that $2,000 purchase and the interest you would have paid over that time frame if you, no kidding, just kept paying minimum payments. So again, I mean, really, I do applaud you guys for coming out and learning about this topic, because it is a very important thing. And I think when people realize what the long-term ramifications are, it's one of those areas that you just need to watch. So pay down the credit cards. Don't necessarily close credit cards that you're not using. Again, it depends on if they're reporting the capacity. Slow down on opening new accounts. I was kind of sharing with the mayor earlier, when my husband and I first got married, I was definitely the spender. My husband was the saver. It used to make me crazy, because I said, oh, I want to get, we need to get new furniture. We need to get this. And my husband would say, no, let's get this. When that's paid off, then we'll get this. When that's paid off, then we'll get the next thing. And it used to make me crazy. But I'm very thankful that he did that, because we never got too far in debt where we couldn't see the light at the end of the tunnel. If you have had a hiccup or two along the way, establishing credit or reestablishing credit, a couple steps that you can do. Opening a savings and checking account. Again, this is not going to affect your score, but if you have a relationship with a financial institution and you've showed you're making regular deposits, you're able to manage your checking account, when it does come time to possibly get a credit card, you're going to be able to show a positive history of managing your money. Open a small line of unsecured credit. Typically, department store cards are easier to qualify for. Anybody have any idea why? They typically will charge higher interest. So again, they're taking on a little bit more risk, and you're going to pay for that by possibly a higher interest. And you may need a cosigner. One thing that I really, really caution people on is think very hard before you ever cosign on a loan or on a credit account for somebody. Because, when you're pulling your credit report, it is based on your Social Security number. If you cosign on a loan for somebody else, that loan is going to be reported to your credit report as well. So, a good rule of thumb is unless you can make that purchase also, I just wouldn't cosign for it. I had somebody who we teach classes for call me one day, had a person in his office, and he said, Amy, I've got this lady here, and her daughter is in the process of buying a house, and she's having trouble qualifying for a loan, and the realtor suggested, why don't you have your mom co-sign on your home loan? What do you think about that? And I was like, that's a 30-year commitment. And my exact answer was, unless mom can pay for that mortgage payment as well, I wouldn't come close to co-signing on that loan. That you just have to be willing to take that on if you're co-signing. Purchase affordable items, pay them off quickly. When my daughter got her first credit card, she was one of those that just was scared to death of credit cards. Oh no, I don't want one. They're evil. They're bad. And I told her, no, it's how you use it. So she got her first credit card. I said, use it for something that you would normally be purchasing anyway. Putting gas in your car. So she uses it to put gas in her car, and at the end of every month, she pays it off. So she's got, 3-4 years now of steady, I'm making my payments on time to my credit card and paying everything off at the end of the month. So that's good history that she's establishing. I used to kid and say, I use my daughter for the good money examples. When we teach the identity theft class, if any of you come back for that, I use my husband for examples on what not to do there. But, yeah, he makes me crazy. Okay, so some strategies that you can use to help improve your score. And I'm going to share one strategy with you, and I will tell you with a caveat. This is not the right thing for everyone to do. This is just one example. In the handout, it shows that we have an individual that has 5 credit cards. Their credit limits on all 5 of those cards is $25,000. They have charged up $22,500. So they've used up 90% of their capacity, right? We know what kind of effect that has on the credit score. So they only have 10% available. Now, this person was able to consolidate all of that debt into one installment loan. And we actually had somebody do this, but they actually used a couple cars that they owned as collateral for the installment loan. But they consolidated all that debt into one installment loan for 60 payments at 12%, which in this case, 12% I'm sure is probably much cheaper than what they were paying on credit cards. Their payment was $500 a month. It's a nice steady amount. They know at the end of that 60 months they're paid off. It's done. But it has also freed up 100% of their capacity, and it's given them a mix of now they have an installment loan and they have some revolving credit. Here is the big, huge danger with this. You can't make a step like that and run out and start using the credit cards again. I really, I can't stress that enough. That is where a lot of people get into trouble. They'll consolidate debt and then they'll keep using those credit cards like, extra cash. And the credit card balances get bigger and bigger, and that just turns into a vicious cycle. So I will tell you, that may be a strategy that would work for you to save money. In the example that I was telling you about with the car loans, it was pretty close to that. It was $20-some thousand in debt that these individuals had on credit card because the wife had chosen to stay at home with her child, and the husband was working and going to school, so they used credit cards to kind of supplement their income. And they've been making their payments on time. That was all fine. They sat through the credit score class when we gave the little $2,000 example and just realized, oh my goodness, the money we are going to be paying over a great deal of time is just going to be crazy. So they said, we need to do something. And just through conversation, we found out that they owned their cars. We were able to do the installment loan using the cars as collateral, and it saved them $400 a month. I mean, that just is amazing to me. So I will tell you, before you do whatever it is you're going to do, if you need to, if you've got some credit card debt that you need to take care of, that you want to just look at what your options are, I highly recommend that you sit down with somebody who is trained to take an objective look and just give you some good recommendations. So, did I get that clear across, the danger of that? Okay, just making sure. Dispelling a few credit myths. I'm sure you guys have heard these from time to time. If I wait 7 years, it'll just fall off my credit report, right? Like a collection item. Kinda true, kinda not. It's 7 years from when someone stops trying to collect and stops reporting that debt. For example, if I have a debt and I have a collector that's trying to collect on that debt, and they've just given up on me and said, oh my goodness, she's never going to pay this back, they can actually sell that collection to another company who then starts trying to collect, and as long as it's being reported to the credit bureau, it's going to stay on that credit report. And then whenever somebody tries to or stops trying to collect on it, it will stay on there for 7 years. But again, at any time during that, they could sell the collection to somebody else. So don't just think, oh, 7 years and I'm done and it's gone. Not entirely true. Anybody know how long bankruptcies stay on your credit report? 10 years. 10 years. I like this. The more credit cards I have, the better my score will be. Not necessarily. Depends on what you have charged on them. Or the old, if I don't get the bill in the mail, that means I don't have to pay it, right? Remember that little application that you signed that said you agree to pay? I guarantee you there's nowhere in the small print that it says only if you get the bill in the mail. The other thing that you want to watch is Arizona is #1 for identity theft, 5 years in a row. Mail is one way that identity is stolen. So if you don't get a bill in the mail, you might want to be concerned about that. Just kind of throwing that out there. Poor credit score will haunt me forever. We already know that's not true because it's a snapshot. So whatever it is today, you can improve on your score. Okay, and we're just about wrapping up, and we will open it up to questions, and I will stick around. We will stick around as long as you guys need us to answer any questions. Warning signs of too much debt. If you're only making minimum payments, if you're at or near your credit limit on your credit cards, if you're using cash advances to pay for bills, getting calls from collection agencies, or lying to spouse or family about what you're spending. If you're hiding purchases and things like that, that could be a sign. Not saying it is, it could be. But you just want to watch those things. Some things that you want to be aware of too, I call them credit pitfalls, but payday loans, in case you're not aware, payday loans can charge, there's no regulation that says what the cap is that they can charge on the interest rate. So, I mean, we've heard 300, 400, 500, 600%. I mean, it's insane what payday loan places can charge for interest rates. Think about it this way. If you were just being charged 300%, for every dollar you borrow, you are paying 3 back. That's crazy. The federal government came out with legislation close to a year ago for military people. They capped what payday lenders can charge military people, 36%. That's still astronomical, I think. And I think the government stopped short on capping that for everybody. I mean, that's just one area that you really want to watch out for. So if you can avoid those types of places, you want to. Rent to own, the only reason I throw that in there is don't be completely swayed by, you can have this household full of furniture for this low monthly payment. Just know what is the interest rate you're paying, for how long you're paying it. Know what those charges are. That just makes you a better equipped consumer. You know clearly what you're getting into. Remember I told you I was going to tell you how to get out of those pre-screen offers if you want. There's a phone number on here, 888-5-OPT-OUT, or you can go online to optoutprescreen.com. And the options that they give you is you can opt out for 5 years, you can opt out permanently, or you can opt in. Anybody want to opt in? I love that. I guess that's in case you accidentally, check permanent, and just in case you want to get back in. It's not going to stop every pre-approved offer from coming, but it will cut down a lot on those. Be careful of high interest debt consolidation. The old adage, if it sounds too good to be true, it probably is. Again, just know what you're getting into. And then again, for identity theft, typically when identity theft happens, your credit report is one of the first places that it will show up. And I will tell you, if any of you have children, it's not a bad idea. When you go through to check your credit report, if you put your child's social security number in there and a report comes up, that could be a clue that somebody has stolen your child's identity. We've had people in our classes, 7-year-old boy whose identity was stolen for employment purposes. But the reason it's becoming more common in children is because when is typically the first time a child is going to find out their identity is stolen? When they're 18 and they're able to apply for their first credit card. So if you put your child's social security number in there and no report comes up, that's good news. Okay. You can either do it online, or you can go on, I think I put the phone numbers in here for the credit bureaus. When you call the credit bureaus, you can do it over the phone as well. And then I had said you're allowed to get your credit report free one time a year from each of the bureaus. There's a few different ways that you can get it. no matter how you get it, I like to caution, make sure that it's your, again, make sure what you're getting. Even if you go to annualcreditreport.com, if you go to that website to get your credit report, they will automatically give you all 3 reports, one from each bureau, okay? Don't inadvertently, unless you want to, but be careful, those places, even the credit bureaus, will let you sign up for free credit monitoring for the first month, and then they'll automatically bill you after that. So again, just be mindful of what you're signing up for if you're getting your credit report. You get your credit report for free. They will charge you for your score. Okay? Any of those places will charge you for the score. Credit report is free. Oh, go ahead.
But with the information you gave us and the percentages and such, you can come close to figuring out your score yourself if you have your report. Is that?
I think it'd be pretty tricky to figure it out. Yeah.
Okay.
Yeah. I think you'd have difficulty figuring that out on your
So
own.
it's worth paying for your score.
Or I'll give you another option. She's like, what's she up to? Okay. And before I get into that, another thing that you may do if you are concerned about identity theft, I've heard of people doing this. If you go to annual credit report, you get all 3. Another way that you could do it is stagger your reports. So say in January you pull your report, you go directly to TransUnion and say, I'd like my 1 free credit report, thank you. And then 4 months later you go to Experian and say, I'd like my 1 free credit report, thank you. And you just rotate them every 4 months. That's kind of a way that you can check your credit on a regular basis. Another way that you can check your credit report and score, this is a free service that we offer. There is you don't have to be a member of the credit union. I'm going to steal a sheet out of here. You don't have to be a member of the credit union to do this, but if you fill out this form, you can come into any of our branches. We will pull your credit report. We will tell you what your score is. It shows you right on the credit report how much of your capacity you've used. It'll show you what all your accounts are, and you'll have somebody, if you go to the branch over here in Avondale, you'll have somebody like Chris sitting there telling you, here's maybe some things that you can do to help improve your score or whatever. That's kind of a nice thing. And like I said, you don't have to be a member. It doesn't cost you anything. It will cost you a couple points on your score because this would count as a hard inquiry. Okay, because we're the financial institution pulling it. And the credit report actually has to stay in our possession. It's not something that we can give you to take home with you. But that is one way, like I said, you can get your credit report and your score, just an option. And some other ways that you can get your credit report, if you're ever denied for a loan or anybody says, well, this is based on information that we saw in your credit report, you are entitled to get a free credit report for that. If you're denied employment or a loan or anything like that based on information in your credit report, you can request a free one for that. Another good reason it's a good idea to check your credit report on a regular basis, there is a 50% error rate on credit reports. When we first moved out here from Pennsylvania and we were buying our house, I kind of joked with my mother-in-law, but my mother-in-law's Bon-Ton charge account, which is a little department store in western Pennsylvania, was showing up on my credit report. So I said, you better pay your bill on time. But seriously, anything that you find on your credit report that is not yours, you can dispute it. And there is, in the back of your packet, there's a sample dispute letter that you can send to the credit bureau saying, this account is not mine, whatever the reason is, or any, maybe it's an account that was paid off or whatever. Anytime you dispute anything on your credit report, you should do it in writing. They're not going to take just a phone call that says, no, really, this account's not mine. Okay, let's take it off. It doesn't happen that way. Sometimes it might take a little bit of work on your part, but you definitely want to do that in writing. I will tell you about one other thing that's in your packet. This is just, again, applaud you guys for coming out and learning about this topic. We also have a little thing in here. If you decide that you wanted to have an account or something at Credit Union West, if you live, work, or worship in Maricopa County or Yavapai County, you're eligible to be a member, and it requires a $5 deposit into a savings account. We'll make your first deposit. So just kind of throwing that out. Again, are you taxed on that? On the interest on the $5? Oh, no, not as a gift. No. No, no, no. Nope. But you will be taxed on the interest. Yeah. Every year you will be taxed on the interest. That's just something that's added. But again, I'm happy to stick around if you guys have any, individual questions, or if Chris can answer anything. Thanks again for coming out.